Welcome to Fund Finance Friday Industry Conversations. I'm Wes Misson. I'm not sure today's guest needs any introduction. I'm here with my longtime friend and former partner, Mike Mascia. Mike, welcome.
Hey, thanks, Wes. How you doing?
Doing real well, Mike. It's great to see you as always. Good to have you as our guest today, and huge congrats on the recent closing and launch of the fund finance business at EverBank.
Yeah, thanks. It was fun to get to this milestone. It's certainly felt like a long time coming for Jeff and I.
Mike, this launch has created a lot of buzz. I know it's been about 18 months in the making. And you think about it, you've got two of the biggest stars in fund finance coming together, two of the OGs, if you will. If you don't mind sharing, how did this all happen?
Yeah, well, certainly that's kind of you. Look, it's been an exciting and fun ride for us, and different too. Jeff and I were out last spring, as you know, and we were trying to raise money for a track record fund. And, we got introduced by Dee Sklar, no surprise there, to Warburg Pincus. And we had always liked the idea of trying to form a fund finance forward bank. And Warburg Pincus was looking at buying a bank, and they asked us, what would a business plan look like if we asked you all to prepare it, with fund finance being the forward part of the asset side of the balance sheet. So Jeff and I did, and we got excited about it. And the moment we started working on it, we knew that it could be a winner. And when we presented it to the investor group, they seemed to think it could be a winner too. And ultimately, we all came together on this partnership to move it forward. It just took a long time because that's the nature of bank M&A. The deal went under contract back in November, and ultimately consummated in the closing last week. So good to get to that milestone.
Yeah, well, certainly cheers to that. Awesome to get to that point. And as somebody who was a deal lawyer by trade and was used to closing deals within a couple of months, I'm sure at times it had to be frustrating that the process took so long, but certainly for good reason.
Yeah, thanks. There were definitely days where we wish we could have contributed more to the M&A part of it. There were a lot of parts of the transaction that just were not requiring our skills in terms of loan asset origination. So now it sort of feels like we got the green light to get moving. So that's kind of fun for us.
Excited for you, and I know you've got a lot of folks in your camp rooting for you, and I'm sure many are, frankly curious about with the macro environment we found ourselves in. How has the regional bank stress impacted your plan?
Yeah, well, Jeff likes to joke that there probably have been less disruptive times to put a regional bank under contract. But the reality is we have hung in there really well. Most of our bank's depositors were insured depositors, so we've been more stable than a lot of the banks. But like everybody, there's been a transition in the mix of deposits from non-interest bearing more to CDs and brokered CDs and the like. And so that has certainly put some pressure on NIM forecasts and the like. And it certainly led to us pivoting our business plan a little bit to bring treasury services in as a product offering to our clients sooner, so we can be a contributor to deposit gathering, as well as accelerate our plans for syndication and distribution.
Yeah, well, I'm sure a lot of this, no way you could have foreseen back in the, what we were seeing early last year, at the time you all were concocting the plan, and it's you got to stay nimble, I guess, is the name of the game.
Yeah, that's right. I mean, look, the banks that were impacted here the most were certainly great friends of mine and people I care about a lot. So I certainly followed all of this very carefully. I think all of us have spent more time focused on bank balance sheets here in the last 5 months than we ever have before, which has some silver linings, and that we've all learned a lot. Glad for a lot of the folks that they've landed on their feet too. With all this going on, Wes, I'm sure it's been impactful for your practice as well. How have things been going at CADS?
Yeah, well, look, I mean, certainly I'd be much happier if none of this happened, as I'm sure you would. But I feel like a president now that's entering the second term, in terms of the amount of gray hairs that have developed on my head. But look, it's been a good thing in terms of it's kept us on our toes. You got to follow the ever-changing tides, and certainly they've been changing by the day. we grew the team tremendously last year, added, 25 to 30 different attorneys just in fund finance globally. And we've stayed remarkably busy. Certainly that was a concern for me is, with deal origination, it's no secret that it's down this year. How are we going to keep everyone busy? And we've been able to do that with activity levels really remaining at the same peak as last year, but it's just a completely different kind of busy, right? And March brought a number of fire drills. And it seems like we've been working with the FDIC on a daily basis. And as well as I do, for what we do, you're not used to working with the government all the time. And so that's been certainly an educational experience and a first for all of us. But even so, I think we're excited for the transitions that have happened, for our friends and colleagues in the industry and the new players, such as EverBank and what the future holds for all of us.
Yeah, that's right. I mean, I'm glad to hear things are going well. I mean, certainly, this disruption is also creating a lot of opportunity for all of us. And it's one of the things that kind of gives me some excitement here about, our go forward business plans. Like, I think there really is a lot of opportunity out there for us to capture white space that currently exists in the market. And I think the same for you all too, frankly.
Yeah, absolutely. It seems like there's been no better time than for some liquidity to come into the market. Give us a little bit of a history of the bank. I mean, I'm familiar with TIA Bank, but I'm sure many folks who are viewing are not, and certainly not familiar with the EverBank name. But give us a little bit of history about that, and then why the name change.
Yeah, you bet. So EverBank as a brand is not de novo. It was a bank that existed that TIA Bank bought about a decade ago and then merged and integrated. And largely over the last decade, they've focused on being a great service provider to the TIA participant network, which is huge and is still going to be a massive part of our bank going forward. The brand was one that had a lot of existing goodwill, so it was kind of easy for us to revert back in connection with our transaction. But TIA will still be a major part. They're an investor in the bank going forward. Their constituent base will certainly still be a big part of our deposit base and client base. So we're really optimistic that they're going to continue to be a great partner for the go forward bank.
And what really kind of makes EverBank different?
So, one of the things that really attracted me to the opportunity right from the start was that our board and our C-suite have knowledge of fund finance at the practitioner level. This isn't a situation where they need to be taught what the product line is. They really understand it and use it in their daily business and have been managed it, in the case of our C-suite for years. So that's certainly exciting for us. The other thing, we a little bit as a business vertical are a de novo in the sense that we don't have a lot of legacy portfolio or policies or the like, and we can really craft this thing in Jeff and my's vision for what a next century 3.0 type of fund finance bank would look like, which gives us a lot of flexibility and opportunity to kind of design things the way we think will be in the best interest of the customers. And then finally, look, I mean, we've got Jeff Johnston, right? I mean, he's got just a tremendous vision for what we're trying to build and a lot of ideas, and that creates a lot of energy for all of us to get up and get after it every morning.
Yeah, for sure. I can't think of a more exciting combo than you and Jeff to launch something like this. So, can't wait to see how this all comes together.
Thank you.
But clearly, it's not just you and Jeff. This is going to be a bigger team operation. How are the plans for building that out coming along?
Yeah, so we're super excited. We've got some brand name hires that will be announced imminently. So more to come on that, but imminently we've got some folks joining that we're really, really excited about. We've also added Josh Kinsey, who was part of the existing TIA Bank Fund Finance vertical, who's going to slide over and join up with us. And I mean, he's just proven to be fantastic, as well as given us direct access into an understanding of how the existing policies and infrastructure at the bank work. So he's been a really great add for us as well.
Yeah, I'm sure it's been quite a learning curve, figuring out all the internal, systems and getting up to speed on how the bank has been operating, and then now trying to integrate your own plan and make tweaks to that.
Yeah, I mean, look, the bank is it's not a tiny little organization. I mean, they've got a really good infrastructure process, and they've got good plumbing here. We're learning it, when I talk about what we're focused on right now, we're certainly focused on making sure we understand exactly how our infrastructure and operations work. We're trying to, get our NAV policy in place and then fully make sure we understand how our subscription facility policy as applied to particular transactions will work. So we can either tweak it or we can get to a good understanding so we can get clients' yeses and nos faster. And so those are certainly some of the key things that we're working on right now.
And then kind of in terms of what's the footprint of the bank going to look like? You and Jeff, are you going to sit in Charlotte?
Yeah, so we'll sit in Charlotte. We're going to, build the nucleus of the fund finance group here in Charlotte. But obviously, there's talent everywhere, and we don't want to be limited geography wise in terms of where we recruit talent. So, I'm sure we'll have folks in other locations as well.
What are the top 3 things that you're focused on in the immediate term here?
Yeah, so in addition to kind of, making sure we've got our plumbing right and ready to deliver in the way for clients that, we want to be able to deliver for them. We're also working on our pipeline. We've got a commitment here to, start making loans here in the fall. And so we're working on our pipeline development for sure. And then we're also working on our syndication and distribution capability. So trying to source from our bank relationships as well as be able to place paper with our bank relationships. So those are certainly our key focuses right now.
What type of, segment of fund finance and client are you most focused on, if you don't mind me asking?
No, not at all. Not at all. I mean, I joke a lot that we're not going to out Wells Fargo, right? We're not going to come to market with a signature type of business plan. Instead, we need to be realistic with the size balance sheet and other structural advantages that we have. And so what we're going to focus on are bespoke funding needs, right? So a little bit less of down the middle subscription, the pure play kind of subscription that you and I built our early careers on, but more of the hybrid facilities, the NAV facilities, subscription that's more challenging, things where people need a bank that will spend some time with them to structure a solution that meets their particular use case. That's where we think we can be most relevant to clients. That's where we think we can punch above our balance sheet weight and really build the unique franchise.
And then, because I've been kind of wondering this, right? Like if you put Tom Brady and Peyton Manning on the same team, that's awesome. But like, how does that actually work in practice, right? Like, how is your role going to be different than Jeff's? And tell me a little bit about that.
Yeah, okay, that analogy is ridiculous, but first of all, Jeff and I are really comfortable swimming in each other's lanes, and we get along really well and have for nearly 20 years. And so it's not something we spend a lot of time worrying about. But there are certain natural things where, his experience set has far more reps than mine. And so when we think about general allocation or responsibilities, I mean, Jeff will probably more than not handle direct client origination. He'll handle our underwriting and then our KPIs, where I will lean more into sourcing from our bank relationships, execution and making sure the clients are kept happy, and then ultimately syndication and distribution.
Do you think that's going to evolve over time, or,
look, over time, we've got really big ambitions, and, we think there's going to be a real evolution in our market where distribution is going to become far more relevant. We think there will be a bond market. We think there will be capital markets and securitization products in our segment. And I think over time, we're going to look to build those things, and, where the market has needs, we're going to look to come in with solutions, and, whoever between us is best able to kind of lead a particular matter for a particular client is how we'll probably line it up.
It's so funny to hear you say this too, because you and I used to joke all the time a few years back that nothing ever changed in our market, right? We'd write the market update article that we'd come out with every year, and we'd be struggling to like dig in to talk about, okay, we argued over a few sanctions points, or there was this new overcall limit that we saw, but pricing was all about the same. And, it was just kind of plain vanilla and boring, right? And now we've got anything but that, right? We've got all kinds of headwinds. You've got a lot of change going on. You got the banking crisis. The challenges have proved to be many and have impacted a lot of people over the last year. What, in your mind, what are the biggest issues that are facing our market in general, the fund finance market today, and how do we solve for those?
Yeah, to go back to your analogy about tides, like you remember when COVID was first coming out, it felt like we were standing on the beach and a tsunami might be coming, and we had to figure out what the hell to do and how to get our butts off the beach in case it did come. I think where we are now is different. It's more like being in a kayak out on the lake on July 4th, where there are 100 motorboats going in different directions. And there are lots of waves coming at you in all directions, but they're all small. If you think about this week alone, right, the 10 years popped over 4%. Moody's downgraded the banking industry yesterday. We're all absorbing the proposed reg cap changes. I mean, there are a lot of things that are changing, and I think that will change our business, right? I think the days of running a subscription facility assembly line factory are over. I think the transactions are going to require more customization for the borrower's evolving use cases. I think we're going to need more tailored structuring to kind of keep the cost of delivery for the banks lower, right? Uncommitted tranches as an example, more term tranches as an example. We're going to need ratings to be able to access the insurance market, maybe even ratings, in order to keep our regulatory capital holds lower on the U.S. side potentially. So, what I think that translates to is transactions are going to be more bespoke, and they're going to require more senior people who can put in the time to kind of structure a solution that works for both the borrower, but also complies with the changing landscape of the treasury departments at the bank. And so I think that will kind of help the more senior people. It's going to take more of our time. Staffing will definitely trend senior, which will have efficiency ratio implications. But it also creates a lot of opportunity for those of us who have been in the industry for a long time and have more of a solutions mindset as opposed to a factory mindset. So we think, that sort of plays into our hands strategically, that, we're not going to be running a subscription facility factory here. We're going to be running an organization that tries to customize particular bespoke, NAV and hybrid oriented deals for borrowers' particular needs. So we feel like our strategy aligns well with the market evolution.
Yeah, I was going to ask, how's the EverBank kayak? How's it navigating those wakes?
Yeah, look, I think we're doing really, really well. We're really fortunate with the structure of our transaction that allows us to bring some balance sheet to market with us. Now we need to be thoughtful about the deployment tenor, because just like everybody else, 2 years from now, we're going to need deposit growth to be able to keep up the pace of deployment that we hope to come to market with. But we are pretty fortunate to be able to come to market this fall with balance sheet and the ability to do transactions.
Well, look, I'm shifting gears for a minute. I mean, you spoke a little bit about what's going on in our market in terms of regulatory capital challenges and the like. I've been hearing some rumors that through this process, you've actually become a phenomenal bank regulatory lawyer yourself. So I've got to ask, do you have your eye on the Basel Endgame regulations that were just proposed a couple of weeks ago? And, if so, what are your initial thoughts on how that may shape our market?
Yeah, my instinct is that the name Endgame is probably about as on point as the Inflation Reduction Act was in terms of a good name. I just can't imagine these things don't continue to evolve. When I looked at the proposal, and like everybody, I mean, it's over 1,000 pages and I'm trying to absorb it, and I'm, looking a lot at the secondary materials as opposed to the source materials, but I'm pretty optimistic for fund finance that the implications will be largely around the margins. Look, I think they're real. I think, for many of the larger banks, the capital hold requirements are going to go out. The cost of liquidity is going to go up. And we're going to have to be thoughtful. And this goes back to my structuring comments. Like, for so long, it was like, our bank clients would just press a button and the money showed up and they would make the loan, and they didn't even have to think about the source of funding, or the cost of liquidity or the like. It's going to be more relevant. And so, the unused fees in our world have always been, in my view, underpriced for 2 decades. I think, more accurate pricing on unfunded commitments are coming. Term structures are going to be more valuable, and those things are coming. And that'll play right into the clean down requirements that the funds negotiate with their investors, right? The investors for so long were negotiating all these clean down requirements. Well, if that drives the bank market into a revolver that's massively unfunded, and that makes the cost of financing higher, the GPs really need to revisit that with their LPs, because the structures are all going to need to cooperate to kind of maximize efficiency for the whole.
Yeah, no, that's certainly true. It'll be interesting to see how that evolves and works itself, throughout fund documentation going forward, particularly kind of the new capital market solutions that are on the horizon as well.
Definitely. Well, look, it's great to see you all. I hope you'll send all your young people to Fund Finance University. I'm working on that right now with 1.0 and 2.0 coming up this fall. So please send a bunch of your young folks to the programs.
Yeah, we'll do. We're super appreciative of that program. I know you were the founder of it, and I think it's been phenomenal. A training tool for so many institutions in the industry, and so certainly appreciate all that you do for that. I got to ask you, the first time we've done a public interview together, in a year and a half since you left, do you miss sitting on this side of the table?
I definitely miss you guys for sure. Look, I love Cadwalader. I had a great experience there, and so many of you all were my friends. And I certainly miss the day-to-day of that. For me, I think, look, it was a great run at Cadwalader. But it was time to try to build something new and to see if I could do it again, kind of in a different structure and in a different type of organization. So while I definitely miss it and miss you guys, I'm excited to kind of take my shot at being a banker and see if I can build something on the business side. So bittersweet, but it's going to be great. And, I promise I'll throw you guys a bunch of work when the time comes.
We'll certainly appreciate that. And we miss you a ton. And I know this is something you've always wanted to do. So I'm excited for you. And I know our industry is super fortunate to have both you and Jeff back in the game. We wish you the best of luck with the launch, and look forward to great things. Thank you so much for joining us, Mike.
Thanks, Wes.